So we just talked about LIFO reserve. Now let's look at LIFO liquidation. Let's first look at an example here. So the example is, suppose in January, I purchased 10,000 units at $20 per unit. And then in February, I purchased another 6,000 units at 22 each. In March, I purchased 8,000 units at 24 each. In April, I purchased 4,000 units at $30 each. So my total inventory at the end of April is 644,000. And then suppose in May, I purchased another 8,000 units at $35 each, and I sold 6,000 units. So what is my cost of goods sold under LIFO? So in this situation, my cost of goods sold, if the firm has been using LIFO, the cost of goods sold, so last in, first out, the cost of these 6,000 units are coming from the firm's last purchase, this 8,000 units. So those are 6,000 multiplied by 35. So that is 210,000. And this is the situation of no liquidation. However, suppose that we purchased 3,000 units in May and sold 6,000. What is the cost of goods sold under LIFO? So in this situation, so we sold 6,000 units. For the first 3,000 units, those are coming from our last purchase in May. So those are at $35 each. And then for the 3,000 units that has left, we need to take it from the purchase in April. And then the unit cost for those purchases are $30 each. So our cost of goods sold in this situation is 195,000. And this is the situation of liquidation. So what are the difference between liquidation and no liquidation? Under the situation that there's no liquidation, we're not liquidating any of the layers. So this is called an inventory layer. All of those are different inventory layers. You can imagine those being different layers of inventory at different costs. And then the second one, this is the liquidation situation. This means we are liquidating the May inventory. So in May, we purchased 3,000 and we're liquidating all of those 3,000. We're using all of those 3,000 and we have to go back to our previous inventory layer. We have to go back to the inventory that we purchased in April. So this is the situation of a liquidation. So the difference between this 2,100, between this 210,000 and this 195,000. So the difference, this 15,000, it is the before tax LIFO liquidation profit. So what is the meaning here? So as you can see here that by purchasing 5,000 units less, our cost of goods sold is actually lower, which means that our net income is higher. So this is the before tax LIFO liquidation profit. This is just the profit we get from liquidating our most recent layer and be able to go back one layer to use the old cost, which is cheaper. So assuming the tax rate is 40%, the net effect of liquidation is to increase net income by 15,000 multiplied by 1 minus 40%. So that's 9,000. So this is the benefit that brings by liquidating one inventory layers. And then LIFO liquidation is actually associated with earnings management. Can you take 5 minutes, think about if I am a firm, how can I use this LIFO liquidation to manage my earnings? So how can we use it? Managers can manipulate reported income through strategic timing of inventory purchase and the LIFO, right? So I can just, by strategically time when I am going to purchase new inventory, I can decide how much of the old inventory I'm going to use. I want to put into my cost of goods sold. And then I can use that to manipulate my cost of goods sold. So this is how firms may use LIFO to manage their earnings. And then limitations of LIFO. So first of all, probability of LIFO inventory layers being liquidated. Inventory layers relate to different purchase of inventory at different unit costs. So it can be a potential way for firm to manage its earnings. And record keeping costs of unit LIFO can be significant. So as you can see here, and also as we have seen in the previous practice, when a firm has numerous individual units of inventory, the bookkeeping cost of this, how to calculate those costs can be get a little bit more difficult and complicated. And when unit costs change often during a period, so this is when we have different inventory layers. So the bookkeeping cost of unit LIFO can sometimes be higher than the bookkeeping cost of FIFO. So that's why sometimes internally firms would use FIFO instead of LIFO. And then they're going to make a journal entry to record the LIFO reserve in order to adjust the ending cost of inventory from FIFO, which is what they get from their internal record, to adjust from that to LIFO, which is what they need for financial reporting purpose.